Monday, March 22nd, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how the Bundesbank, the German central bank, admits that the Bank for International Settlements, or BIS, is at the heart of the precious metals market manipulation, or gold market manipulation, gold price. They call it intervention, of course, which is a euphemism for that. And I'm going to reference this book here, Germany's Gold, which is actually published by the Bundesbank. And they readily admit it here in this book that it is the BIS and was the BIS back in the 1960s during the London gold pool. And I'm going to go through that. I'm going to read through the part of the book. There are a lot of people out there who are worried. I can understand that because this is a financial war. They don't want the little people like us, the deplorables, so to speak, to protect themselves financially because they want us under their control. And gold and silver, in the long term, if you can hold them, give you a lot of financial independence. But of course, with their manipulation of the price, it makes it harder for a lot of people to keep a hold of their gold and silver because through life, of course, we all go through financial hardships. And I understand that. And I have been through that. And it isn't easy. But even during the 1960s, when the price of gold was supposedly fixed at $35 an ounce, and they manipulated the price of gold, they eventually couldn't continue. And by they, I mean the major treasuries of the world, the major central banks. And that's despite the fact that Americans were at the time prohibited from buying gold. That prohibition lasted until January 1st, 1975. So despite that, the manipulation couldn't go on. And I'm going to touch upon also the fallacy, in my opinion, that higher interest rates are going to be detrimental to gold. And I'm going to go through that in the video as well. So let's start. This is on page 82 of this book. It says, the gold pool, stabilizing gold parity in the gold market. Well, yeah, that's making sure that they manipulate the price to keep it under or at $35. It says, when in November 1960, the price of gold in the London free gold market rose to $40 an ounce. Yes, $40. The Banque de France governor Jacques Brunet was the first to propose that central banks stabilize gold parity at $35 an ounce by intervening in the London gold market. And what you have to understand, gold has always been money. So has silver. And it's traded in the foreign exchange market, and it is still done so today. The LBMA is basically a foreign exchange market. The COMEX is a commodities market, and I would say that the COMEX is an instrument of these bankers to manipulate the price. COMEX Gold Future, of course, was started or created on December 31st, 1974, one day before gold became legal for Americans. However, substantial gold sales by the Soviet Union and measures taken by the U.S. Treasury on private gold ownership in the U.S. helped to calm the market in the months thereafter, and gold parity was more or less restored. But it was at this point that the committees of the BIS and IMF started to examine the topic more closely. So there you go, IMF involved as well. The idea, so I'll just stop here a second. So when the BIS, the World Economic Forum, and the IMF say they want to help the world economy, they don't. They don't want to help you. They want to help the bankers themselves. The idea of gold market intervention was first officially broached by the United States at an IMF conference in September 1961. And it was subsequently agreed that the industrial nations would work together to stabilize the Bretton Woods system against the backdrop of geopolitical events such as the construction of the Berlin Wall in August 61 and the Cuban Missile Crisis in 62, as well as deepening problems with the pound sterling following the revaluation of the Deutsche Mark in March 1961 and the steadily expanding U.S. balance of payments deficits, calls to make instruments available to intervene in the markets in the event of currency crises were growing even louder. The first line of defense in terms of stabilizing the Bretton Woods system would be to fix the US dollar to gold. The idea of a gold pool was first officially discussed at a BIS meeting of central bank governors in November 61. So why do they do it at the BIS, which is the bank for the central bankers? And I highly recommend this book by Adam Liebord, The Tower of Basel. BIS, of course, is in Basel, Switzerland. The shadowy history of the secret bank that runs the world. So highly recommend this book. Why do they do it at the BIS? Because the BIS, even though it's based in Switzerland, it's a sovereign entity. It's treated as as a sovereign nation. It can do whatever it wants. The Swiss police cannot go in there unless there's a criminal case against someone that works at the BIS. They can't. And the central bankers, when they travel there every other month to meet, to talk about these things, about intervening in the foreign exchange market and gold and probably silver as well these days, they carry diplomatic passports. Customs cannot check their briefcases or luggage or anything. And they can do things that in normal national markets are considered illegal, like manipulating the markets. And they do all the trading, a lot of the trading for the central banks, as we will see here. And even some years ago, the CME confirmed that they have a free program, expirations and extensions. This is for, volume discount for trading futures on the CME. And they include, as you can see here, central bank incentive program, allows central banks and multilateral development banks, multilateral financial institutions, BIS, to trade futures. And they give them volume discounts. So why would the central banks, BIS, have to trade gold futures or other futures? Right? It's to manipulate the market. So let's continue here. There was little consensus during the discussion, however. While the Bundesbank under President Karl Blessing was one of the gold pool's advocates, the Bank of England feared that pool operations would have feedback effects on the free gold market in London. Furthermore, it saw the gold pool as a threat to the hitherto privileged relationship with South Africa, the world's largest gold producer. In turn, other central banks were concerned about being hamstrung in the gold market and getting roped in an agreement with an uncertain outcome. Finally, the BIS's concern focused on its importance and role as a service provider to other central banks in the gold market, which could possibly have been affected under the gold pool agreements. In the end, though, despite the misgivings, they all agreed to be part of the U.S. initiative to create a gold pool. So I'm not going to go through the whole thing here. So you've got the idea that the BIS is at the head of this, and the BIS is the banker for all the central banks. And as you see a little bit further along, the Bundesbank used the BIS for its interventions, and I'm sure the other central banks do the same, and they still do to this day. So when it started out, the London Gold Pool, back in November 61, there was a total of $270 million worth of gold that was used to intervene. And by the end of the gold pool, which was 1968, when countries gave up because they were losing a lot of gold. They didn't want to lose gold to keep the dollar price of gold fixed. They knew the U.S. was abusing its privilege of being the reserve currency by printing a lot of money out of thin air to pay for things like the Vietnam War and also the breads and butter policy of Lyndon Johnson. They were running big current account and trade deficits and budget deficits as well. So this part here, it talks about how the BIS is still involved in this. And I think Zero Hedge has covered this. There's a gold trader at the BIS that they talk about always. And yes, a lot of the times gold is attacked quite early during European times, around right now, which is like 8 a.m. London, 9 a.m. On the continent in Switzerland. The BIS comes in and they start putting, intervening in the market for the central banks. So it says here, in 1968, they couldn't keep going because the French were the first ones to say, no, I don't want to keep, we don't want to keep giving our gold away to protect the US dollar. And then all the other countries got, how can I say, exited this London gold pool. I think the last ones left were the United States and Great Britain. But just to give you an idea, the USA was involved, Germany, UK, France, Italy, Netherlands, Belgium, and Switzerland. And that's in order of contribution. So by 1968, the US was on its own, and then they just stopped as well. And then you had what you call a two-tier market, where the free market in London was allowed to trade at whatever price it did. And then you had the central bank market where they traded at 35. By 1971, of course, Nixon closed the gold window. And gold, of course, went all the way to almost 900 by 1980. So it says here, during each financial year, the inflows and outflows of gold via US dollar gold swaps were booked through a gold site account that the Bundesbank held with the BIS. Interventions in investment transactions and physical transfers of gold between the different storage locations used by the Bundesbank were also settled through this account. A certain amount of book gold was usually left on the gold site account at the end of every financial year. Any gold over and above this given amount was delivered via the BIS in the form of physical gold to the Fed and the Bank of England storage locations. That's why Germany had a lot of its gold at the Fed and at the Bank of England. And of course, they took most of that gold out a few years ago, and they had a lot of difficulty getting that gold out from the Federal Reserve. And also, of course, the intervention. Bankers always like to, how can I say, hypothecate their fractional reserve scheme, and they do the same thing with gold. They'll lend it many times over in order to keep the price down. So this is the important part about what's happening now, right? This made the BIS, the Bundesbank's most important business partner by far during the EPU and Bretton Woods area. EPU is the European Payment Union. Not only did the BIS act as the settlement agents of the EPU member countries for the monthly EPU multilateral settlements and as a link between many central banks in the event of foreign exchange market interventions, the BIS was then, as today, an important service provider in the management of their currency reserves. Well, for that, read in interventions, in manipulation, service provider, right? Not least of all, the BIS managed the distribution of Germany's gold holdings between the Bundesbank storage locations at the Fed, the Bank of England, the Bank of Canada, the Swiss National Bank, and the Banque de France. So, do we need more proof? Bob Moriarty. Bob Moriarty, he's a good guy. He keeps this blog called 321gold.com, but he doesn't believe that central banks manipulate or intervene in the gold markets for some reason, even though they tell you about it, and that's coming from the Bundesbank. So, yes, even during a period where Americans couldn't buy gold, right, when they were under a gold exchange system, it wasn't a pure gold standard, when there was agreement between the central banks of keeping the price suppressed, they failed eventually. And they will fail this time because the market always wins. And how and when is it going to happen? I don't know when it's going to happen, but how it's going to happen is that one of the big parties involved in all this manipulation, be a Treasury, central bank, they're going to say, wait, we're running out of gold. We can't do that anymore. And you also have pressure from people like us and big investors as well, which was true back in the 60s. In the international gold market in London, investors were demanding physical delivery. And that's why I always say you need to get physical. And so do the big investors. They need to realize that buying gold through these banks is not an option if they really want to be outside the system and protect their wealth. So, yes, I think they're going to have an even tougher time in keeping, and they're already having, than they did in the 1960s through the London gold pool. And eventually the scheme they have now is all going to unravel. And I think we're very near that point. And that's why the market seems so crazy, where you have huge premiums for silver, huge weights. You have mints holding back on the supply. You have even gold being, having to wait a long time to get your physical gold. So I think we're very near there. But they're going to put up a fight. They always put up a fight. That's what human nature is. When people are in control, they don't want to lose control. They'll fight till the end. But I think they will lose. And yes, I know it's hard for little people like us, because sometimes we need to get rid of our gold and silver because of a rainy day, right? But and that's why I keep saying, try to live within your means. That's what I try to do. Try not to play their game, and try to do it gradually, dollar cost average. Don't buy more than you can afford to. It's just like savings, right? So with that, let's look at the markets this morning. It's 8:07 a.m. London. Before I do look at the markets, just wanted to show you the chart of the US 10-year yield from 1962, right? Which was right around the time the London gold pool started, up until, let's say, the beginning of 1980s. And you can see that it went from around 4%. In 1970, it was at 8%. And then 1975, it was at 8% again. And then eventually it topped almost at 16%. That's the 10-year yield. And during that period, that was the period when they manipulated the price of gold because it was going up in the free market. And then after Nixon closed the gold window, the price of gold, of course, was freed, and it went to almost $900 in 1980. And despite that, the 10-year yield went from 4% to 16% almost. So all those people out there who are concerned about yields going up and being negative for gold, I would consider that. So right now, even though yields this morning are down, gold and silver have been hammered again. They're getting desperate. And I think I'm going to buy some more physical silver today anyway. So gold right now, it's at 1729, down 15 for no reason really whatsoever. Probably the BIS intervening. It's down just under 1%. It's been down to 1727. The high's been 1747. We got silver down 72 cents, almost down 3%. It's crazy that a market where there are shortages, where the mints won't let small investors get their silver, like at the Perth Mint, where people are waiting months for the physical silver, that the market goes down. It's crazy, but the real physical market, of course, is completely different. So we are at 25.50. The low's been 25.45. The high 26.30. The Dow futures down 167 points. Nasdaq is up 44. S&P down 10. Sterling is down 0.2% at 138.42. The euro is down 0.2 as well at 118.79. The dollar's down an eighth versus the yen at 108.70, and the dollar's up slightly versus the yuan at 6.51. High grade copper is down 0.5% at 409. WTI crude is down 1.33% at 60.61. So the 10-year yield, you'd think, oh, the 10-year yield must be up today because gold is down, right? And I thought that before I turned on my computer because I'd seen the price of gold. But no, the 10-year yield is down almost 5 basis points, around 169. So there you go. So much for that correlation, right? So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these platforms below here. I wish you all a great day. Take care. Bye.